Hello, this is Doug Gerlach from iClubcentral. Welcome to our Investment Club webinar. Today is March 21st, 2023. Tonight, we're going to take a look at a topic that hopefully your club won't have to deal with too frequently. It's the death of a partner, and how do you handle that final withdrawal? Are there any special considerations you need to make? This is something that, when it comes up, is very important to your club. And when you're not faced with this situation, it may be of less interest, but chances are that at some point in your club's history, you may need to deal with the circumstances surrounding the death of a partner. So that's what we're going to be talking about tonight. Russell and Sean and Treva as well are all in the back office. So if you have questions, they will be able to help out with those. We'll also be able to take questions during the presentation and answer them as best we can. The GoToWebinar application has a link to the handout in PDF format, so you can download that. That is all of the slides from our presentation that can be useful for future reference to refresh your memory at some point down the road. And the questions box is also there for you to type in your questions at any point during the presentation. I will be monitoring those questions, and as I said, the team is also in the back office and may be able to provide a response as well. So let's get started and talk about how to handle the death of a partner in an investment club, give you our ideas for best practices when this arises. Now, I must start with a disclaimer in that we as iClubcentral and I personally do not provide legal or financial advice on a personal basis to anyone, individual investors or investment clubs. However, we do have decades of experience, and that is literally decades of experience with investment clubs, investing partnerships, and so we can offer a number of suggestions and pitfalls to avoid based on our cumulative experience. We have seen it all throughout the years at iClubcentral and certainly have a wealth of knowledge and practical experience to base this presentation on. There will always be opportunities for accountants and lawyers to chime in with some other opinions or to make things more complicated than perhaps they need to be. And certainly if we're talking about a multi-million-dollar investment club, your circumstances may be slightly different from a club that may have 50 or several $100,000 in assets. But if you do have questions or if you wish to deviate from our suggestions, then it is always a good idea to seek out competent legal advice before taking action. Don't go on the basis of something you read on the internet when large sums of money are ever involved. Having said that, it's also the beginning point for our discussion about handling the death of a partner always begins with don't overcomplicate things. The withdrawal of a deceased partner from your partnership is really the same as any other final total withdrawal by any living member of your club. And if you do nothing else except follow your partnership agreement as it lays out a final withdrawal, and if you follow our recommendations, you will have no trouble whatsoever. Our experience is that the minute that you deviate from those recommendations that we're going to talk about tonight, when you deviate from your partnership agreement, when some executor or heir comes in and says, well, can't you just, and then has a suggestion that you might follow, that's when you run the risk of running into problems with handling that final withdrawal. So as always, I like to keep things simple. I believe that you as in your investment club should take that same tack. Don't overcomplicate things, be straightforward, don't make things more complicated than they need to be. Now we're talking about a withdrawal, and if you want to understand withdrawals better, in May of 2022, we did a webinar in this monthly series that was led by Russell Malley, our official club accounting advisor at iClubcentral, and Russell described everything you needed to know about investment club withdrawals in that webinar, and that is archived on our iClub Central channel on YouTube. So you can go there to find that, as well as all of our club webinar recordings. There will be a link to the handout as well. And we do provide plenty of other information about processing member withdrawals in the myiclub.com help and on the iclub.com support page. So if you have questions about withdrawals, check out those resources. The first rule for any withdrawal is always follow your partnership agreement. Your club's partnership agreement or bylaws, which we cumulatively describe as your operating documents, should outline exactly how the death of a partner is handled. So in all cases, follow those directives. Don't deviate from them whatsoever. If they diverge from the suggestions in this presentation, your partnership agreement should be deemed as overriding any of our recommendations today. If you're not happy with the partnership agreement and its handling of member withdrawals or final withdrawals or withdrawals of deceased partners, then you should specify that in a revision of your partnership agreement. Now, you can't do that after as soon as a partner dies and then you decide you don't like it. No, you're bound to the agreement that deceased partner signed. So it might be a good idea to review your partnership agreement, make sure that everyone in the club understands the principles by which their withdrawal will be processed if they pass away while they are a member. Now, the model in partnership agreement that Better Investing and iClub Central have developed and have adapted over the course of 60 plus years states this very straightforward, very succinctly in the section entitled Death or Incapacity of a Partner. In the event of the death or incapacity of a partner, receipt of notice shall be treated as a notice of full withdrawal. And that simply says that when you hear that a partner has passed away, that becomes the withdrawal date, and you will go ahead and process a full withdrawal for that partner. Now, a few definitions. Incapacity can be interpreted in many ways. That's in many is something of a very broad term, gives you a lot of latitude. We have heard of cases of partners who have deteriorating health or mental condition that does not allow them to continue in the club. In those cases, the club may choose, and I would be an advocate of allowing for some sort of inactive status for a certain period of time while the circumstances surrounding that partner's condition are investigated, even as they're not able to fulfill the responsibilities to the club. Maybe you're in touch with the family, maybe the partner himself or herself will make that decision that it's time for them to withdraw from the club. We have heard of also some pretty scary stories of a partner who is obviously not in the best health, but wants to continue in the club, but they're not really participating very fruitfully for themselves or other members. And in those cases, again, the club has some latitude how they might handle that. Receipt of notice of death, again, is pretty broad. It doesn't necessarily require any sort of formal notice to be made. If you hear from a family member, or if you read an obituary in a newspaper or see a social media posting that you can verify, then that might constitute receipt of notice of death. And that's important because that sets the time frame by which the withdrawal procedures kick in. So you can interpret that as you wish, but I certainly wouldn't demand a death certificate from the family or some sort of written declaration. But again, be respectful and use your discretion. And then the full withdrawal, your operating documents will have that clear definition, hopefully, about how full member withdrawals are processed. So you hear that a partner has passed away Often it may not be a surprise. The partner may have been in ill health or in the hospital. And so when you hear the word, that kicks in the full withdrawal. If it's very sudden, then again, it's likely that you will hear about it at some point, and that will again trigger the withdrawal procedures. So per the model partnership agreement, the full withdrawal process goes something like this. The notice is formally accepted, presented at a club meeting. So if a notice is received prior to a meeting, then the meeting date is deemed as the date that the formal notice was received by the club. And so that starts the clock ticking on the withdrawal process. The valuation date at that meeting, when the notice is received, determines the value of the withdrawing member's interest in the club. And then based on the model agreement, it'll be about a month, 30 days before the payout to that member. And this is, again, many clubs will extend that period. We don't recommend it. In the case of a withdrawal, we believe that a 30-day waiting period is fine. That gives the club plenty of time to sell securities if they need to raise cash if they want to make transfers if they have to, and satisfy any member's withdrawal within that 30-day window. So we think that is perfectly reasonable and don't believe that you should extend it beyond that 30-day window to 60 days or 90 days or 180 days. And we've heard some pretty egregious timeframes for payouts of a member wishing a withdrawal. But the valuation is set as of that meeting where the notice of death / notice of withdrawal is received. Now, in many cases, in the case of a total withdrawal, there are tax benefits of transferring shares of highly appreciated stock to pay out any member's final withdrawal. This has benefits for the club in that it defers capital gain taxes for all of the continuing members, and there's not really a downside for the member receiving the shares. Again, watch the webinar on member withdrawals for more about the benefits to the club of transferring appreciated stock. Now, in the case of a deceased partner, it may be much more difficult to transfer shares because you're not dealing with the partner directly, you're dealing with the estate, with the executor, with the heir, with the family, and so that complicates things a little bit. The deceased member's brokerage firm, in some cases, even if you know the account or have the account, they might not be willing to accept transfers of stock or securities into that account because they will have been informed that their client has deceased, so that it may be impossible, even if they're at the same brokerage firm, or a different brokerage firm may be even more complicated. In some cases, the executor may have a brokerage account, a separate account that they open to help with the liquidation of assets or the dispersal of assets, in which it might be, the estate of such and such individual would be the name of the account. That account might be able to accept withdrawals transfers of security. Again, there could be significant delays in transferring shares using this method, and that might be a deterrent. That might be a very good reason why you want to keep things simple and not worry about making those share transfers to that deceased member's estate. It might also complicate things for them. Instead of getting the cash, they're getting securities that now they have to figure out what to do with those securities. Do they sell them immediately? Do they try to divide them up? It's much easier in many cases to deal with cash. Shirley asks, it's the date you receive the notice, not the date of death, that starts the clock ticking, and that is correct. So you receive the notice, and that might be a month later, it might be 2 days later, it doesn't really matter. When the club or any of the club members hear that, receive that notice, receive that information, make it known to the rest of the club the next meeting, that's the date that you record in the minutes that the club was informed of the death of this partner, and so the final withdrawal was discussed in in terms of accommodating the payout within the 30-day window. So as I mentioned, despite those significant advantages in transferring highly appreciated shares, if you don't have any appreciated shares, or if you perceive there are going to be delays or complications that make it too difficult, then paying off in cash might be an easier and a preferred method. If you don't have cash on hand, again, a lot of clubs for final withdrawals are always worried they don't have enough cash, so they frantically ask members to contribute more. They agonize over what securities they might sell, and in those cases, it's always best, I think, to do a portfolio review, because chances are excellent that you've got stocks that you're holding at a loss in your portfolio that have maybe been underperformers, that are not contributing to the diversification of your portfolio. And in those cases, selling the shares at a loss, capturing the capital loss, and using that cash to make the payout not only is more straightforward in terms of processing the withdrawal, it's also good in terms of the portfolio health, because you're removing perhaps some of the weaker performers. And even if you're not absolutely convinced that selling that stock was the best idea, that it may have a good future, good prospects down the road, within 30 days or after 30 days, you can revisit those shares to purchase them again. You've got to wait 30 days whenever you sell shares at a loss in order not to trigger the wash sale, which would disallow that loss, kind of defeats the purpose of selling the shares at a loss from the tax perspective. So those are the recommendations. If you absolutely have to, would you sell a stock to generate capital gains to pay off a full withdrawal in most cases, because you're incurring capital gains that are going to have to be paid in the current tax year by all partners, and it is not advantageous to the club. So if you've got to pay off in cash, look to your weak performers first and foremost, and that will allow you to reap the most benefits from the sale of those securities. Now, this is very key, and this is often a question that people have. Who do I write the check to for that final withdrawal payment? We have the cash in the account. Now, do I write the check to the wife, to the family? And the answer is you always make the check payable to the member's name directly, or to, if you have to, write estate of the deceased member's name, right? It's completely possible for a financial institution to accept a payment written to the name of an account holder who has passed away. Otherwise, this would totally impede the flow of funds if you had to go back to every financial institution or person who was payment that was coming to the deceased person to say, no, you've got to rewrite that check and make it payable to estate of. So if you simply write it, the check payable to the member's name, then you will be fine. But for some reason, many clubs and treasurers resist this, and so if you have to write estate of, that seems to be fine as well. In absolutely no case should you ever write the check in the name of any other family member, any other individual, even if the executor requests it. Again, it's not your obligation to follow the instructions of a third party. The deceased member has already agreed to the terms of their withdrawal by signing the partnership agreement. So you want to honor that arrangement and provide the funds in the fashion as outlined in the partnership agreement. If the executor persists and you are confident that this is the right course of action, make sure that you have written instructions from the executor. Make sure that you know that the executor is the executor. Make sure that everything is in writing and well documented. If you deviate whatsoever, and just keep in mind that you are going to be liable if the instructions the executor provides are wrong, if the executor was not the correct executor, if it was a family member that you listened to that said, no, just write this check out to the daughter, and that's the way the will is set up. And you do that willy-nilly, and then the son comes around and says, we noticed that there's a balance in this investment club account according to this valuation statement I have, and I haven't seen that. We haven't seen that money in the estate yet. And you say, well, I know I wrote the check and sent it to the daughter. Well, you don't know all the family dynamics. You don't know the individual's will. You don't know the circumstances there. The son could well be in rights to say, all right, send us the money, or we'll see you in court and file suit against you. So we want you to avoid those types of circumstances. If you don't have instructions from the executor or the family, and again, we'll talk more about making sure that you've got those connections to the family, then send the check to the last known address of the deceased member. And that's the best you can do. We suggest using certified mail with return receipt or registered mail, some sort of documented delivery format, so that you can record a signature and verify that an envelope was sent to this to the deceased's address as you know it. Yes, go ahead, Russell.
In some of these situations, I've asked the club if they get instructions to send something from the executor to a particular person, like you said, have it in writing, but it might be a good idea to have the executor include a liability waiver saying the club shall be held blameless if this isn't correct.
Yep, absolutely. Absolutely. Definitely, you've got to be looking out for the interests of the entire partnership. And so that is an excellent suggestion. We'll talk more in just a minute about beneficiaries and how that comes into play, but let's just point out one potential problem spot is withdrawals that span a calendar year. For instance, you have a death that occurs in December, so the meeting at the beginning of December, you receive notice of the death of the partner, and then you schedule that payout in 30 days in January. That can be a problem because they're still a member as of the next in January, which is the next tax year, which pushes things into the following year in terms of tax filings and Schedule K1s, and so in those cases you would want to make sure to kind of pull that back. We're working on a change to the My iClub software club accounting engine that would help with those circumstances so that they don't show up in the next year's tax return as well. But for now, if this happens, contact us and we'll help you navigate through that withdrawal transaction. So let's talk about trusts, which are a very popular way of handling asset distribution and transfer after the death of an individual. It certainly might help with stock transfers to pay a deceased member if the members are holding their club interest in a living trust, because then it's, these are set up to handle these types of property transfers. But there's a big but connected with allowing trusts in your investment club, and the complication arises with the IRS's centralized audit regime for partnerships. That CAR is the set of rules that govern how the IRS conducts audits and levies liability for shortfalls when they're considering partnership tax returns. And so it's possible for investment clubs to opt out of those rules and use a default set of rules or I'm sorry, use a non-default set of rules which are more beneficial for partnerships. But the downside of that is that you can't have a trust, even a living trust, as a partner if you wish to affect that opt-out. And again, we have done webinars on this opt-out of the audit regime and the audit rules. Essentially, if you don't opt out and the IRS finds an issue and a shortfall or levies penalties, then the members of the current partnership, when the IRS conducts the audit, are responsible for any penalties, any shortfalls, etc. If you do opt out, the IRS conducts that same audit, finds that shortfall, uh, issues fines, then it's not the current partners who are responsible, it's the individuals who are partners when the IRS found the issues with the tax return, which could be 3 or 4 or 5 years ago. And so you can see the problem here is that any new member who comes into the club after that year with the problem, if you don't opt out of that audit regime, they now have a penalty liability that's going to eat into their partnership account for something that happened well before they were a member that they didn't have anything to do with. So we think it's fairer to opt out of that centralized audit regime and allow the partners who were partners at the time of the problem to bear any penalties that might be assessed, as opposed to any current partners, because now you're also into liability when someone joins your partnership and you have not opted out and you do have a problem, and all of a sudden this person is being assessed a portion of a penalty for something that they had nothing to do with, then that person would rightfully be angry at could be angry at the partnership and say, you didn't tell me that I could be liable for something that happened years before I was a partner. And you know, if there were significant sums involved, that individual might well be within rights to seek legal guidance against the partnership, which just exacerbates the issue because you didn't disclose it. If you did disclose it, maybe that's going to soften the blow. But I wouldn't join a partnership that disclosed that they did not follow the centralized audit regime, or they did not opt out of the centralized audit regime, so by joining, I was now potentially party to IRS assessments. So sorry for that little deviation from our course now, just to kind of cover that. But so from our perspective, that overshadows the issue or the simplicity of transferring shares to partners who have living trusts that hold their club interest. So you need to figure it out on your own. Clubs need to determine what they wish to do. From our perspective, again, most individuals, their club interest is not going to be 80% or 40% or 20% of their estate. It might be 3% of their total assets. So having this one investment club account outside their living trust is generally not going to be a significant problem for them. It's not going to be a significant issue in terms of their estate to have to deal with one account that's not part of their living trust. Again, but you'll need to decide that for your own. So the next issue, as I mentioned earlier, we're going to talk about beneficiaries, because clubs often think, oh, this is a smart way to handle it. We'll allow each member to sign a beneficiary statement, and then if they pass away while they're partners, we know who to make the check out to, and we will it'll be easy, straightforward. We don't have to worry about anything else. Well, you still have to worry about the withdrawal. You still have to write the check. It's just a matter of who you're writing a check to. The problem with the beneficiaries, there are a number of them. The enforceability of them vary by state. Every state has different rules. So, and even if they are enforceable in your state, they may not take precedence over an individual's will or trust agreement or other last request documents in the state. So that means the member may have a will that specifically says that my interest in this investment club shall go to this person, or shall be split amongst these heirs in such a fashion. Would not be uncommon. Or they might say, all of my investing accounts should be disposed of this way. This is my wish. And forgetting that they signed a beneficiary statement. Again, if the club is large enough and the member's interest is large enough, and the club writes a check payable to the beneficiary, and then the executor comes around and says, but I have the will here, and the will says that the money is supposed to go to to this account, or this individual, or this person. It should be part of the estate. So I'm going to need that check from you. Well, you've already paid the money. Now what are you going to do? You're going to recover the funds from the beneficiary that you wrote the check to? Again, in these cases, it's easy to write the check. It is next to impossible to get the check back. But now you're on the hook. Your club members are on the hook for that payment that was made erroneously. So we don't advise getting in the middle of it. There's nothing to be gained from beneficiary statements. There's really nothing that makes it easier from the club's perspective, and the risks are simply too great. Now, yes, large financial institutions, Vanguard and TD Ameritrade and Schwab and Fidelity, they all allow beneficiary statements. How come your club can't have beneficiary statements? Those financial institutions have enormous staff attorneys who do nothing but make sure that if a claim comes in against a beneficiary, that they can fight it successfully and validate the use of beneficiary statements in all the states, all the jurisdictions in which they do business. And so they're in a much different position than your investment club. So they're geared up to handle conflict. Your investment club would need to lawyer up, and so that's going to cost you money, and it's going to be could be a difficult road for you to follow. So we like to suggest that you stay out of family disagreements and avoid those beneficiary statements. They are not going to do as much as you think in terms of simplifying the process of withdrawing after a partner has passed away. Now, that is not to say that we can't know who the next of kin, the emergency contact, who the family is. It is a good idea. And we do have a field a couple of fields in the My iClub member profiles where members can add their emergency contact and put in that phone number for that emergency contact. Let people know that they are. And the point of the emergency contact is not only when the partner trips coming out of a club meeting and breaks their leg, and so now you know who to call, but it's also in the case of a passing. Who do you get in touch with and say, we're so sorry to hear this, our condolences to the family, we're processing this withdrawal. We'll have it in 3 weeks. We'll have the check. We're going to send it. Here's what we're going to do. We're going to say, is that correct? And go through that whole process with the family. So that's why we want you to have that emergency contact information. It's a good idea to keep that updated. I would guess that most clubs and most members haven't looked at that emergency contact field in their member profile in My iClub since they created their account, years and years and years ago. So that would be a good checklist for your club. To remind members, please update your emergency contact information. Make sure that we know who to contact if there is a problem. And if you want, the secretary wants to collect that information and keep it in a secure file somewhere off of My iClub, again, that's fine as well. But this is the intention of that emergency contact field. So I said I said earlier, it's good to keep it simple. And again, we hear all sorts of requests. One request that's not that uncommon is, there's a couple, a married couple who are members of the club, and they want to know, well, when the husband passes away, can't the husband's club account just be transferred to the wife's account in the club? Again, this is entirely possible. We don't have a transaction set up for it in my iClub. Because generally our rule of thumb is we don't want members to be transferring to other members. We can't account for all of the different permutations of a person to person transfer of property, which is what a club interest is. And so we don't want to get involved in that. But for a married couple, again, in most states, this is not necessarily going to be a big problem. Partnership interest is property. So keep that in mind. And so the basis is stepped up at the time of transfer, and we'll talk about that in a minute as well. But if you're in this situation, you've got a family member who is in the club, and you feel confident that by transferring the club interest to the existing member of the club, that you're not going to be violating the terms of any will or instructions from the executor, then this is something that is possible to be done. Just let us know and we can provide the instructions on it. We can't provide guidance on the legality of it, but we can tell you the terms and how to accomplish it in my iClub. Now, it also comes up that people want to transfer their interest to a non-member, that the mother wants to transfer the interest to her daughter, who's, a 30-something working professional, and the mother thinks this is a great way to kickstart the daughter's investing and wants them to be a member of the club. So again, it is possible to, again, transfer a member's club interest to a non-member. However, the club cannot be forced to accept that new individual as a partner. They have to come through the same process as any other member who's joining your club. So whatever the procedures you have for accepting someone and voting to allow them to be a partner, that new individual must satisfy those same terms and conditions. So if you don't want to accept them, or if they say they want to be a member and then never show up at a meeting, you've got a good clue that maybe this isn't a good idea. So again, we can provide some instructions on how to accommodate the recording of the transaction, the transfer of the club interest. But if it doesn't work out, then you would go ahead and process that withdrawal in a normal fashion. Every withdrawal that you do needs to be accompanied by the member withdrawal distribution report. This includes important information that's used in preparing the individual's tax return, or in the case of a deceased partner, the estate's tax return. And the information on the withdrawal report is not all included on the Schedule K-1 at year end. So the Schedule K-1 and the withdrawal report are two separate documents with two different sets of required information to complete an individual's tax return. This is why at the end of the year, we remind club treasurers that you need to send the withdrawal report along with the K-1 to any members who've done any withdrawals during the year. This is also a good idea that when you send that withdrawal report along with the check, that you include a note that reminds them they will be receiving a K-1 at in the next February or March from the partnership, that would be the final K-1 for their club interest, and just to let them know that those two bits of information will be required for that estate's tax return. The Schedule K-1, again, it's going to be generated for that deceased partner after that final withdrawal, along with the other members. And there might be a K-1 from the state as well. So those are going to need to be sent. It might be a good idea to confirm where that should be sent. Is it the same address? Is there an accountant or a tax preparer that should be sent to in the next tax year? And again, if you don't have that information, all you can do is send the information to the last known address of the deceased member or an address provided by the executor. But it is your obligation to provide that K1 even to the deceased partners, and it is good practice to send the member withdrawal report because they need, that has important information on it that they need. Something that comes up occasionally is that a check isn't cashed by a deceased partner. So if that's the case, it may be the executor contacts the club and says, we haven't received a payment, we haven't received the check. And you say, well, we sent the check. And they say, well, can you send another check? Well, can you send, all right. So we just go back and forth here. If the executor says, oh, we got the check, we couldn't cash it because it was not written to the estate, again, you can argue with lawyers, but usually it's not worth your time. Ask them to just send a request in writing, send that, if they have the check, void the check and send it back to the club. When you receive those, you can write the replacement check and deliver it. If you write the check and it comes back as undeliverable and you can't find a family member to send it to, you have no information on next of kin, again, you should be doing, do your due diligence. This is why we recommend having that emergency contact information. If it doesn't come back, then it's not free money for the rest of the club. After a certain period of time, you would need to submit it to your state's lost property office. And so contact them. They will tell you after what period you have to submit the funds. They'll send you you can get the forms from the website that you would send with it, and you would send it to the state, and then they will put it in their lost property register. And if nobody collects it after a certain number of years, then the state disposes of it as according to their policies.
Doug, I just want to say, some states, that office is called unclaimed property. So abandoned or unclaimed.
Abandoned property, unclaimed property, yeah. Those are, but as you search for your state's website, you would be able to find it. Again, this doesn't happen that frequently, but it has happened. We have seen clubs that have, we're sitting on $7,000 here that's in the account, but we don't have, the check got sent back. We can't find the family. So the correct thing to do in that case is to submit it to the state. As we near the end here, we'll talk about the basis step up for inherited property under IRS laws or IRS rules. When you inherit property, including securities, the basis of that property is stepped up to the current value at the date property is inherited, which is the date of death. And there are some circumstances in which that there can be an alternate date that is utilized. But the idea here is that if you receive shares as part of an inheritance, the capital gains that were unrealized before go away. And so if you were to sell those shares on the day that you receive them, even though the basis might have been 10% or 20% of these long held shares, there would be no capital gains liability because you sold your basis was, $150,000. That's what it was stepped up to, and you sold it for $150,000, and so there would be no capital gains. So this is, often considered a loophole, but it works to the advantage of investors because it allows you to build up wealth and then transfer that wealth without capital gains taxes. Now, there might be other estate taxes, certainly, but the basis calculation is, essentially not a function of the club accounting software. The distribution report, the withdrawal report, does include the member's basis in their club, and all that an accountant or an executor needs to know is what's the basis as of the date of death. So you don't have to provide the documentation of the basis setup. You don't need to make adjustments to the values. You just need to provide the withdrawal distribution report and the and then the K1 at tax time. Russell, did we get that right, or do you have some any elucidating comments?
Oh, I'm sorry, I was writing about. Yeah, there's a way for us to step up the basis, and usually it is at the time of death. So um, if I didn't get that right, the question, yeah.
Yeah, no,
Oh,
I
and
was,
yeah, and it's not up to the club, right?
yeah,
You should don't worry about it. That's the responsibility of the executor to figure that out.
yeah,
You can give them all
yeah.
the information on the withdrawal and the withdrawal report and the K1, and they should be able to figure it out.
Yep, yep. That's the salient point, is that you don't have to worry. That's part of what the executor needs to do is to figure that basis step up. So provide the information, answer the questions. There's nothing you need to do to adjust it. All right. So a couple closing thoughts. By all means, send flowers to a member service. If the club wishes, they should record those as non-investment expenses in the club's books. That's fine. If you make a charitable gift in honor of the deceased member, as is common, you can record that as a charitable contribution in the club's books. We support that transaction as well. And again, these are fine human things to do, and especially for a long-standing club member. You should feel free as a club to make those kinds of gestures. And just a couple of final thoughts on final withdrawals. We're not talking about financial transactions alone by themselves in this discussion. We understand this can be an emotional time. We do suggest being timely in handling the withdrawal payout, be respectful, be professional to the family, the heirs, the executors. They're going through a tough time. Your club members may be going through a tough time as well, but don't delay things or make things extra complicated. Try to be efficient, and that will be in the family's interest as well. And also don't neglect the emotional aspects on the current club members of losing a long-standing partner. That can be difficult. So each club can handle it as they wish. And again, we would suggest not considering it merely as a transaction that happens, but taking the time to acknowledge that individual, send a card, contact the family, reach out, be a participant, be supportive, and don't be an impartial observer. That's not the nature of investment clubs in the modern movement. So with that, let me take a look at the questions real quick. I see the team has been very busy in the back office answering any questions. If anybody was having difficulty with sound, there is the recording that you can revisit later on. Jimmy asks about deferring taxes on a stock transfer. Again, the full withdrawal webinar, or the withdrawal webinar that we talked about, will give you more details. But in the case of a full partner withdrawal, when you transfer highly appreciated securities to that member as part of that withdrawal payout, the capital gains that were unrealized become recorded on the club's books as a liability that's deferred, in essence. And so the taxes on those gains are deferred for each partner in the club at the time until each of the partner withdraws. So when the partner withdraws, they take their share of the deferred capital gains with them at that time. So the advantage is that if you're in the club for 10 more years after the stock transfer is made, you're not going to be paying capital gains taxes until 10 years later. And that's a pretty good deal. You know, it's rare that you can avoid capital gains. It's next to impossible except under some very specific circumstances. But if we can defer gains for 10 years, and maybe in 10 years the capital gains rate might be lower. I know it doesn't always work that way, but you know, who knows what's going to happen. Maybe your income level would be lower in 10 years, and so you might fall into a different capital gains tax rate. So that's why we suggest it. From the departing member's perspective, it doesn't make any difference to their withdrawal, whether they get highly appreciated shares or cash. We suggest not giving them underappreciated shares because the club loses the ability to record the capital losses if you transfer depreciated shares to members in a final withdrawal. But at any rate, see the member withdrawal webinar for more details on the specifics of that. All right, well, with that, I think we're going to wrap it up. I want to thank the team, Russell, Sean, and Treva in the back office. Thanks to all of you for turning out at our event. Congratulations to all you club treasurers who've completed your club taxes for another year. And we'll look forward to seeing you at our next club webinar in April. We're going to be talking about disbanding your club and how not to disband your club if you're running into particular problems. So again, almost every club at some point will be faced with the decision about disbanding, and so we're going to be reviewing those procedures and processes that go into closing down your investment club. That'll be our topic in April. So we'll look forward to seeing you there. I wish you all the best in these turbulent times. Stay the course in the market, and thanks once again.